Morning, ladies and gentlemen. Greg Michalowski from ForexLive.com. This is the January 6, 2023 Forex Technical Report, where I take a look at the markets from a technical perspective and also take a look from a fundamental perspective. And today we had some jobs reports coming out of the U.S. and Canada, so let's get into it. In the U.S., we saw non-farm payroll rise by better than expected, 223 versus 200,000. But the what was key for the markets, at least the initial reaction, is the wage data. The average hourly earnings in the U.S. rose by 0.3%, which was lower than the 0.4% expected. Not only that, but the prior month was revised to 0.4% from 0.6%, and that moved the year-on-year rate to 4.6% from 5.1% last month and 5.0% expected. And so it was better from the wage standpoint, better from an inflation standpoint, and that may take some of the pressure off the Federal Reserve to worry about that component of inflation. The problem is the unemployment rate remains very low at 3.5%. That's near all-time low levels or decade low levels for it. And so does that mean that wage inflation is just around the corner again? We will know, but that's a tightrope that the Federal Reserve will be moving along over the next few months. But what we know from the Federal Reserve, or at least from the comments that we've seen over the last few days, is that the Federal Reserve wants to continue to get more restrictive and keep the rate steady, according to Esther George, well into 2024. We'll see what other comments. We have some Fed speakers later on today. In Canada, we also saw employment come out much better than expected. 104,000 new jobs created. They were expecting only 8,000, so much stronger than expectation. The unemployment rate went to 5%. That is also near low levels from a historical standpoint in that country. The problem with the employment report in Canada is that this will probably keep the Bank of Canada looking toward tightening policy, and that has a direct impact on mortgages. Already, consumers in Canada are feeling the pinch from higher mortgage rates. They adjust in Canada. Most of the mortgages or large percentage of the mortgages are adjustable, as opposed to the U.S. where they're fixed. So the impact of interest rate hikes in Canada are much more felt by the consumer. That's not only for discretionary, but also non-discretionary items for some people. So it's heading for a car crash. It seems like we'll see what happens. But the Canadian dollar is stronger as a result of the U.S. dollar is weaker as a result of this data. So let's take a look at some of the charts. We'll start by looking at the euro versus U.S. dollar. And if we take a look at this currency pair, we are seeing the euro move higher, the dollar move lower. And if I put it on the 4-hour chart, I'm going to show you the importance of some of the levels here in play. And if we look at the 4-hour chart, this swing area right here was defined by where we bottomed here today, was defined by this high, these high right here, there's lows right through here, lows through here, lows through here, lows through right here. And then we came down and we tested the low area of that swing area, and because of the number, we've seen the price move higher, and the price is now moving above the 200 bar moving average of the on this 4-hour chart. That comes in at 105.34. We're currently trading at 105.40. We are also above the 105.15.5 level again. And what's the significance of that? If I go to the daily chart and I take a look at the range from 2022, from the high price right here to the low price right here, the 105.15.5 level is this 50% retracement level, and is in trading earlier this week, the market came down to that level, found support. Trading yesterday, the market came down to that level and found support, and closed near the level. We did move to the downside in trading here today, and tested this old high going back to November right through here before finding that support, and that was a level on the daily chart as well. And we the number has now pushed the price back above the 50% retracement level at 1.05155. That is going to be our barometer for bullish above and bearish below going forward. And so watch that level as long as the price can remain above 1.05155. A more supportive from a technical perspective in the euro versus US dollar, and I think you should be too. Let's take a look at the dollar versus yen, and that currency pair has moved to the downside with the general move to the downside in the US dollar here. We did move above this key swing area in trading here today in hopes for guess, continuation of the US dollar to the upside. That was a significant break from a technical perspective, but it came right before the numbers, so we kind of discount it as position squaring or concerns, fear, so on and so forth, that caused the market to move to the upside and tick above that level. Let's call it holding the level and then moving back to the downside. But over here, this day right here, this is the Bank of Japan day, where they said that they would target the 10-year rate at 0.5% versus 0.25%, and that sent the yen sharply to the upside, the US dollar versus yen to the downside. And so we are back below this swing area right here after, let's call it testing it, moving down to the downside. It keeps the sellers back in play, and it looks like a nice big V here, victory here for the move to the downside, move back to the upside. The sellers are a little bit more in control. Watch the 50% retracement level. I'm going to use that level as our barometer for the upside today. Stay below is more bearish. Move above and start scratching your head as far as do we go higher or lower for this currency pair on the downside. The 38.2% retracement level at 132.81 will be a target, as will the 100 and 200 bar moving averages. This is green lines at 200, the 100s are the blue lines at 100. Getting down to and through those levels would be more bearish. We based against it in trading yesterday before moving to the upside and moving above the 38.2% and 50%, so on and so forth. So watch those levels for the dollar versus yen. Let's take a look at the sterling versus US dollar. I'm going to put it on the let's put it on the daily chart here. And if we take a look at the move down, this is going back a long ways, but to this high right here, to this low right here, the 38.2% came in at 1.18408, and that's where the price found its bottom here, also near swing lows and highs through here, where near the high of that. So that's a good bounce off of that level off the daily chart. On the hourly chart, lots of up and down volatility here in this currency pair. I'm going to put a Fibonacci from this high to this is the high for the week to the low for the week. We came or coming up to the 38.2% retracement, which also corresponds with these highs through here in this swing area. This swing area, I have to go to the 4-hour chart to show you its importance, and it goes really back to this period right through here where the market had a ceiling, and then floor, broke through the floor, failed, and then rotated back to the upside. We did up and down around that area through the month of so far in the month of January. So getting above that level or that area right there would be more bullish. And I'll go back to the hourly chart. This is that area right through there. So get above the 38.2% retracement above these highs to get above this swing area through here, and that's more bullish for the sterling versus US dollar. I mentioned the dollar versus Canada is moving to the downside here. The Canadian dollar is getting stronger, the dollar is getting weaker, US dollar is getting weaker. We move back below the 100 and 200 hour moving average. Lots of ups and downs, volatility here in this currency pair. You can outline the value area where most of the trading has taken place in between these levels. We did move below that this area through here in trading last week, and also in trading here this week, but we found support against the 100-day moving average down here and rotated back to the upside. So stay below the 100 and 200 hour moving average is more bearish for this currency pair. Move below these lows and below the 100-day moving average increases the bearish bias for the dollar versus Canada. Be aware and be prepared. So there you have it. Look at some of the major currency pairs. My name is Greg Mikulowski. Good fortune with your trading. Bye-bye now.